Welcome to another episode of ETF 360. I'm Tom Lydon with ETF Trends, and joining me today is Ed Rosenberg, head of ETFs at American Century. Ed, my friend, how are you?
I'm good. How are you, Tom?
Excellent, excellent. Hey, Ed, you talk to thousands of advisors every year. We know that the biggest concern that advisors have had recently has been both inflation and rising interest rates. So when you think of that, why would investors or advisors even invest in bond ETFs today?
So here's the interesting part, right? The ag just had its worst quarter ever, I believe, down over 6%. And what that has meant is we're finally getting rates where you actually can get a return on normal investments. But that creates a problem, right? If you go into something like the ag, the Fed's talked about how many more rate hikes from this point forward, 7, 8, or 9 going forward, and others have said that's too slow. We need to go faster as opposed to a quarter point. So why would you invest in fixed income now? Because it creates a steady stream of income. But what you get into now is you need to be more selective. You need to look for things that create higher yield. Potentially active is even better in this environment, and that have a shorter duration to prepare for those rate hikes, because we want to take advantage of those yields, but not necessarily get hurt on the principal.
Yeah, you're a big fan of ETFs. You've been in the business for a long period of time. There are a lot of advisors who have bought ag related or highly ag correlated ETFs for an extended period who are now jumping ship, or they're cutting different parts of the ag away, as you point out, to invest outside of those core parts of the ag that really aren't doing well. Talk a little bit about some of those areas of the fixed income market that aren't as toxic, let's say.
Yeah, so let's start with one. We talked about duration for a second in the beginning. I mentioned it. You need to go shorter duration now. But then how do you start looking at some of those other areas? One of the places that tends to get hurt most in rising rates is treasuries or government. So how do you stay away from that? You start to look to credit, right? And in this environment, you can start to look at IG or high yield, depending on how you value those high yield. The problem is with some of that is you're relying on the rating agencies. So you want to look for something that's more what I would say the teams themselves do their own analysis to get ahead of when rating agencies may change, or to look for companies they think are better. Other places you want to go are things like emerging markets. Now, that sounds strange with what's going on right now, but a lot of emerging market countries have a really good credit rating, just not as good as the US. So that forces them to offer things at a higher yield to attract investors to that debt. And the last place I would say is there's other areas, things that we don't think about that often, such as preferreds and convertibles. And if you can take advantage of those spaces, what that does for you is generally you're getting income out of convertibles in areas that, quite frankly, are growth stocks, and you don't normally do that. And then you look at preferreds, they always tend, you can set them up so they have a shorter duration. Normally, we don't think of preferreds with duration, but they always pay a higher yield. And if you look at some of just the individual securities, they're paying 5, 6% alone, and that's significantly higher than we get today. And they're not hurt as much by interest rate rises. And Tom, I'm going to tie this together if that's okay. There are funds that you'll have managers that do all of this together, where they're active and they're looking at all these types of securities. Um, and so those are types of funds you can take advantage of as well.
Right. And in American Century, you have one ETF that takes advantage of all those opportunities. MUSE, let's talk a little bit about that. Actively managed. Dig a little bit deeper, if you would.
Yeah, so let's start with MUSE stands for multi-sector income. And the way you rank that is you have core plus, and then you have multi-sector income. And each step you go up takes you a little bit further away from core. And core would be something like ag. And what it does is it gives the portfolio manager more opportunity. So the portfolio manager is investing in things that you would traditionally see in the ag, right? There might be some governments in there, and there might be some investment grade credit. But as you walk away, what you'll find is the portfolio manager is also investing in, and I mean, as you walk away from the ag further away, you see the portfolio manager is investing in securitized. That's not necessarily straight mortgages. It could just be asset-backed securities. They're also investing in high yield, right? In addition, I mentioned emerging markets. So the portfolio manager is going to take advantage of those countries where they can get a higher yield, but they don't feel there's any massive increase of risk going forward. And the last thing, they're taking advantage of the preferred market, which is higher yields at a lower duration. And if you look at how the preferreds, when they trade on the exchanges, their price movement tends to be very little, but yet you're still getting that yield. And what's important about that is the manager in an active fund, especially this one, is turning the dial, right, to the places that make sense. As the environment changes, as the Fed raises rates, it's on the short end. And so what happens is, right, how does that cascade through the curve? Right now we have a little bit of inversion going on. So they're able to take advantage of that. Whereas if you're in a index fund, that is not something that the
Right.
portfolio manager is just saying, let's do this, or let's switch to here. They can't do that.
Yeah.
And this fund's got a higher yield with a potentially lower duration than some of the ag funds that exist today.
So tied all together, Ed, what is the duration and what's the ballpark yield on MUSE?
So I'm going to give you a little bit of a different duration. I'm going to give you the option adjusted duration because some of the bonds have callable options on them.
Okay.
That puts the duration at about 3.25, right? And when you look at the average coupon of the underlying securities, you're talking about a little over 3.75.
Wow.
That's a big difference than what you see today. And then the question I always get to add on to that, Tom, is it diversified, right? Are you really concentrated? As of, the last quarter end, the fund's owning about 225 bonds. So it is diversified. So it's very different than what you get. It's not 9,000 bonds like the ag would be. It's a much more select
Yeah.
list, and the portfolio managers are really putting their best foot forward in each one of the areas, even with that dialing up or dialing down.
So you got income for your clients, you got non-correlation to the ag, you've got diversification. I know you're excited about talking to advisors about this, and I imagine that money is coming from that 60/40 portfolio because we're hearing people are exiting that 40 and they're going to alternative strategies like this.
Yeah, absolutely. And what we found is, forget that I'm excited for a second. The advisors are actually excited because this is a newer space in the ETF world. They're excited that there's a product like this that they can still talk to their clients about owning fixed income, but owning it in a different way, right? Is the risk a little higher than something like the ag? Absolutely, but it's that trade-off, that risk-reward trade-off for the yield that they're really looking for. And as rates go up and it cascades through the curve, hopefully it cascades and we eventually get away from the inverted yield curve we have today to something normal that we're seeing. But as that happens, the portfolio managers are really going to be able to take advantage of that by shifting in and out of different securities to actually the yield's going to go up without the price dropping as far as something like the ag could.
Yeah.
And that's really
Okay.
what they're excited about.
Excellent. Ed, thank you. MUSE. And before we go, happy birthday to you. Happy birthday to you. Happy birthday, Ed Rosenberg. Happy birthday to you. Happy birthday, Ed.
Well, thank you, Tom. That was lovely.